We are live, Ashish and Saurabh.
Hi everyone, I am Ashish Shankar, Head Investments at Motilal Oswal Wealth Management. And I welcome you to the second edition of Know Your 4C Manager. As all of you know by now, we have a very unique framework to identify the best managers in India. And it's amazing that we can do this digitally now in spite of the pandemic that is unfolding around us. And I'm glad to be live on YouTube. This is an attempt by us to bring the managers who are managing your wealth closer to you and try and get deeper into their philosophy and the way they approach portfolio construction. Today, I have a fairly erudite manager with me here. Although he's relatively new to the buy-side industry and he started his fund management journey little over a couple of years back, but he's no stranger to this industry. He's been in the capital markets for close to 2 decades. He's a BSc, MSc from London School of Economics. He was a small cap analyst at Clearwater, which was a firm he co-founded. So I think he had an entrepreneurial bug in him much early in life. He was head of research at Ambit Capital, and he's known for some of his insightful research papers, and which is widely followed by the entire industry. He started his own firm, Marcellus, and he's got off to an amazing start in terms of his entrepreneurial as well as investing journey. A lot of clients have benefited over the last couple of years by investing with him. So I welcome to this show, Saurabh Mukherjea. Saurabh, welcome to the show.
Thanks for having me on the show. Thank you.
Yeah. So first up, Saurabh, I know you shared your thoughts on the current crisis and how it will unfold. We are now about 2.5 months into this crisis, at least in India, and you've seen the lockdown, and you also have many more data points than what you had probably a couple of months back. So I want to start by getting you to share your thoughts on how you see this crisis unfolding. Has your view changed after some data points that have come through, or is it similar to what it was maybe a month and a half back?
I think I remember back in March or April, I forget exactly when, we did several calls for your clients. And I was saying back in late March, early April, that if one looks at the data on India, looks at how many Indians lose their lives, unfortunately, to infectious diseases in a given year. That's around 2.5 million Indians die to infectious diseases in a given year. Back then, we were saying we were not sure why people were getting so hysterical about coronavirus, right? But unfortunately, back in March and April, given the sheer amount of global hysteria around corona and renowned universities publishing papers saying that millions of Indians are going to die, obviously people weren't listening; they were just selling stocks. And as always happens, as the last 3 months have passed, people can see the data. Yes, unfortunately, 6,000 Indians have lost their lives, but people have realized that this is not the mass killer, the mass spreader of panic and havoc that a lot of people had imagined it to be back in March. So that's, I think, the first layer of calmness that is settling in. That people can see, yes, we have 2 lakh COVID cases, but the deaths are simply not as high. And as the government of India has repeatedly pointed out, we have the lowest death rate in the world, right? The other perspective that we are seeing across the world and also in India is, naturally, as you come out of the lockdown, as countries come out of the lockdown, demand recovers. There's no great miracle in this. If you've been locked at home for 80 days, when you come out, you buy cars, you buy washing machines, you buy undergarments, you start living a normal life. And we're seeing that. We first saw that in China a couple of months back, clear data of a V-shaped recovery in consumer durables and auto in China. Companies like Whirlpool and Toyota commented on it. And now over the last 3 weeks, we're seeing that in India, where, say, the southern states, electricity consumption is almost back to normal. And talking to whether it's Page Industries, Nestle, Eicher Motors, you're seeing demand come back to 40, 50, 60% of normal. So I think that's what we'll go through over the next couple of months. The return to normalcy, life returns to normality. Clearly, there might be challenges ahead, right? Our financial system has been in distress for several years, and the financial system distress has only been exacerbated by COVID. So I suspect as we go towards Diwali, we will get another wave of financial system crisis. As you've seen over the last 3 years, every 7-8 months, a major institution goes bust. But that is business as usual in our country. There's nothing unusual about that. I think the COVID panic, thankfully, the worst of it is receded. And as we come out of the lockdown, we'll see demand normalizing over the next 2-3 months.
Right. So I remember you mentioning that although the near term looks challenging and the stress in the financial sector may increase, you have a fascinating chart where you mentioned that a lot of the factors which are required for a longer term sustainable economic recovery and a bull market in India are all coming together.
Absolutely.
Could you elaborate that for us?
Yeah. So I think I remember I did this in the late March, early April chart, late March, early April chat with your clients. We showed a chart where we showed that if you look at India over the last 40 years, every single Indian recovery, every single Indian economic recovery in the last 40 years has been preceded by a recession in America, right? And the reasons for that, we said to your clients a couple of months back, the reasons for that is a recession in America gives India two massive benefits. First is cheap oil. And a US recession typically smashes oil prices by 50 to 80%. And for an oil importing country like us, that's a massive boon. So you can see that this time, right? Oil was $80, $85 back in January. It's now 35, 40. That's around a 3% of GDP benefit to us, right? And that's basically the government's fiscal stimulus. The government's fiscal stimulus is basically the oil price relief translated into money for small businesses and for the poor. But the second and more potent benefit a US recession gives all of us is cheap money. Because the US 10-year bond yield is the world's risk-free rate. And whenever America goes into recession, the US 10-year bond yield plummets. So in the last 5 months, the US 10-year bond yield is down 300 basis points. It's nearly zero now. Imagine the US 10-year bond yield is close to zero now. And that obviously pushes American money out. If you're a US CIO, you're a US fund manager, you can't turn to your endowment or your family office and say, I'm sorry, I can't deliver returns to you because our bond yield is zero. Your job is to search for return. And back in March, back in April, we told investors across the country that American money will come to India, both through the FPI route and through the FDI route, right? And I'm glad so far, at least that prognostication has worked out. We saw what, $3 billion of FPI inflows into the stock market in May, $3 billion of FPI inflows in May. I have good visibility, good reason to believe more is coming from that direction. We look after a small overseas fund, and we're seeing inflows there from overseas endowments and family offices. And the second is the FDI piece, right? The FDI piece has been quite spectacular. Not just Reliance Jio, we're also hearing about LG, Samsung, Foxconn, and in that electronics park near Hyderabad. There's a medical devices park in Chennai coming up. I reckon there'll be defense FDI as well. So the world will come to India, not because of any other reason, but cold commercial calculations that if the American 10-year bond yield is zero and the Indian is 6%, there is money to be made in India. And that's why I think we can look forward over the next 12, 18 months to first the post-COVID pent-up demand coming through, and then secondly, the more longer-lasting effects of cheaper money from the RBI, cheaper money from foreign investors, leading to an economic recovery. India always recovers after America goes into recession. India has never had an economic recovery without a recession. The counterintuitive fact, but a very powerful one.
Right. I think that there was one more point that you had mentioned, that normally when governments are pushed, when their backs are to the wall, that's when they do structural reforms.
Right.
And I think in all the announcements, because the need for immediate aid is so high, people seem to have missed 2-3 announcements which are probably pretty structural in nature. Anything significant that you think that they've done?
So I think what's very interesting is, right, you made a lovely point that reform happens in crisis. Why is that? Why does reform happen in crisis? See, economic reform by definition is going to create winners and losers. If there were no losers from economic reform, you would have had all the economic reform before you and I were born, right? So clearly there's a trade-off to be done when you do economic reform. What happens in a crisis is the government is able to turn around to the country and say, look, either we do this reform or we suffer, right? And hence the loser's voice is muzzled in a crisis, right? And you can see this playing out yet again. We saw this back in 91 in the epic May-June 91 reforms that Manmohan Singh and P.V. Narasimha Rao expedited. And we're seeing that again this time, right? So whether we like it or not, labor reform is happening, right? At one level, one wants to see labor's rights protected, but at another level, as a businessman, I realize that if we don't get a grip on labor laws in our country, nobody really in their right mind globally is going to invest in India. Whether we like it or not, by creating these, electronics parks and medical devices parks, we're giving MNCs a chance to get land, large amounts of land, cheap at easy terms. Um, you can say, well, why should we give that to them? Well, if we don't give them the land on easy terms, they're not going to come and set up their factories, right? Similarly, whether we like it or not, by deregulating agriculture, we're making it easier for modern retail to get fresh produce at the terms they want, rather than going through three layers of middlemen and the food rotting in warehouses, right? So yes, there will be winners and losers from this reform process, where we are bringing in MNCs to the Indian market to set up manufacturing hubs, where we are easing labor laws to make it easier for employers to hire and fire on a large scale. But you need to do this. If we don't do this, capital ain't going to come. If capital doesn't come, it's difficult to develop this country. So I've always seen crises as the harbinger of opportunity. And in a remarkable way, the last 3 months have been almost a textbook. Have been a textbook demonstration of how our country actually benefits from crisis. The pain is all too evident. Smaller businesses struggling is all too evident. The gain takes a while to come, and our job in a way is to second guess that and get parked into the right companies before the gain arrives.
Right. We've seen a crazy fall in March across global markets as well as in India.
Mm-hmm.
And the Nasdaq as well as S&P 500 are back to their all-time highs. Now, this is a playbook that probably none of us have seen, where you had such a sharp cut and a recovery in such a short period of time. I mean, normally we've heard of bear market rallies, or we've heard of bounce backs after a sharp cut. But this is a playbook that honestly I have not seen. What do you make of it?
Right. So if you think about it, fundamentally, it makes sense, right? It makes sense. And here is why it makes sense. Anywhere in the world, any stock price basically discounts the next 20 years of profits, right? We can do DCF and so on, but it's in very simple mathematical terms. A stock price discounts next 20 years of profits. Assume COVID takes away 6 months of profits. Assume it takes away a year of profits, right? It justifies a 5%. Simple mathematics, it justifies a 5-6% drop in stock price. Effectively, what the American markets are saying, and now increasingly the Indian markets seem to agree, yes, COVID is going to take away a couple of quarters of profits, but it doesn't look as if COVID is going to take away even a year of profits, right? In our country, we're down at the market level, we're still down 15% from 1st January. So the Indian stock market is still saying, incorrectly, I believe, that COVID is going to take away 3 years of profits. I find that a little hard to believe, right? If I look at our consistent compounder portfolio, we are down around 5% from 1st January. Basically, our portfolio, the market is saying a year of profits is lost. I don't even believe that. I reckon 2 quarters of profits are going to go. 1Q clearly is a washout. 2Q might be a bit of a difficult quarter as well, but difficult to believe that the whole of the fiscal will be lost, right? So it makes sense, therefore, for rational investor to say that an Asian Paints will sell paint for the remainder of my life. It's just that for the next 3-4 months, Asian Paints might not make any money. Or Page Industries will sell undergarments. People will wear undergarments in India over the next 20 years. It's just that for the first 3-4 months of this fiscal, maybe Page won't make any money. But to extrapolate that and do a massive correction, which is what the market did in March, I thought was wild overreaction. And obviously, as the panic abates, rationality is setting in.
So you think that this will be a very short-lived kind of a bear market, because whilst what you're saying is right, but often we've seen markets remaining cheap or pessimistic for prolonged periods of time, like we saw in 2001 to 3 or 2000 to 2002, or even between 2008 and 2009. You think this will be a short-lived kind of a bear market where the world suddenly realizes that this is an event which is not going to cause as much economic damage as they thought probably in March?
So look, none of us fully understand. I don't think anybody in the world, anywhere in the world, has fully understood the nature of COVID. If COVID is like, those H1N1, Ebola, MERS type of viruses, which, came, surged, created panic and scare, and then gradually a degree of control was got over it. If it is like that, then I think the March the March panic was the bottom of the market. If, however, COVID mutates and comes back in a more potent form, 3, 4, 5 months hence, perhaps next winter, then clearly there is going to be more trouble, right? I'm not a virologist. I unfortunately can't opine on that. So far, what we are seeing both in the West and especially even more intriguingly in India is that we seem to have been visited upon by in India especially, we seem to have been visited upon by a relatively less potent form of the virus, and hence our mortality rates have been pretty low. And even therefore, even as India's case count goes up through June, July, it looks to be a very controllable situation. But if there's a next wave where a more potent form of COVID comes back, then obviously there's challenges. So on COVID, I'm not an expert. If this wave of COVID, if you've seen the worst of COVID already, then I think we are broadly all right on that front. My greater concern for several years has been, and this goes back to even when I was in my previous job, is a financial system. Our financial system has been for a long time now, 6, 7, 8 years. Our financial system has been in a state of disarray, and every year the situation worsens another notch. So I think that's the over a 6 to 12 month horizon. That's my concern. That COVID is not my concern, partly because I don't understand it, but over a 6 to 12 month horizon, I do understand that the NBFC ecosystem will get into more trouble, right? We've already seen the challenges that the debt mutual funds have had. They were the big provider of money for the NBFC ecosystem. The NBFC ecosystem therefore has a twin balance sheet challenge, right? On the liability side, they're going to be struggling for money. On the asset side, they're going to be struggling with moratoriums and after that NPAs. We have 8,000, 9,000 NBFCs in our country. We've seen before 98, 99, we saw 80% of India's NBFCs blew up. So that's my concern over a 12-month horizon, that we will see the weaker NBFCs go through existential challenges. COVID, if the worst of COVID is behind us, the main thing we're going to be wary about is dealing with the financial crisis. The RBI is awake and alive to it, which is why I think Shakti Das will come through with another stimulus through July, August, because he's aware that there's a fragile financial system that the RBI needs to look after.
Yeah. So just to sum up, I think what you're saying is in the near term, the stress in the financial system and developments on COVID could keep markets on edge. However, some of the longer term factors that are required for a sustainable economic recovery and bull run in India are already in place. And you mentioned cost of capital, you mentioned structural reforms, and of course, cheap crude oil prices. Because if you spend less on crude oil prices, essentially you have more to yourself in the country for developmental expenditure, because it's a tax on the savings of the country.
Absolutely. Yeah.
Fair enough. Saurabh, I definitely want to move on to the fascinating story of how you began your entrepreneurship journey. Were the seeds laid way back when you co-founded Clearwater, that you had this bug in you, and you said at some point you might want to start your own business?
Right. So look, yes, I mean, from very early age, I wanted to set up my own business. But obviously, one also realizes that one needs to learn about a country, right? So we set up Clear Capital in the UK. We built it, we sold it, then we migrated to India, and the three of us who've been building Marcellus, we've been working together for 16 years now. So the cohesion has been there for a long time. But when we came to India, Ashish, 12 years ago, we realized that there was a lot to learn. There was a lot to learn about how the country worked, how the financial system worked. We needed to get to know how the regulatory system worked. So we said, let's. There's no rush, right? We've got long careers ahead of us. So we spent a good 10 years understanding the country, getting to meet people, traveling across the country extensively, understanding politics, culture, regulations, and then finally, by the time I was in my early 40s, we had to make a difficult call. So I looked around and looked at my life and said, do I want to take 400 flights a year and not get to see much of my children, and make loads of money as a CEO of an investment bank, which is good fun, and very thankful to my erstwhile colleagues for the opportunities they gave me? Or would I like to spend more time reading, thinking, investing, and spend a little bit more time with the family and get to build a business of my own? So hence the step 2 years back to quit my job as the CEO of the investment bank and set up Marcellus. And as you very kindly highlighted, it's been a good 2 years, and very grateful to you folks for your support. I don't know if you remember, you were the first people to take our product to the market, and very grateful to you folks for your support. But our view for all of us who work in Marcellus, our view always has been that if you are willing to work hard, be creative, think about the world originally, there are opportunities for you to build a business. And in this world of high technology and low setup cost, the entrepreneur option is far easier to pursue than it would have been, say, 20 years ago for the generation which preceded us. So we said, we're early enough to begin a venture. Let's take the plunge, and that's how Marcellus was born a couple of years back.
I've never asked you this question, but how did the name Marcellus come about?
All right. Okay. So one of the things, as you probably have seen with us, is right. We like taking unpopular stands. We like taking unpopular stands, whether it's saying that whether it's saying at the height of a raging bull market that India will recover, or whether it's saying that it does not matter what the PE multiple of a stock is if it's a great company you buy. And I've been attracted throughout my life to people who take unpopular stands. Right, I find them incredibly magnetic. People who high-profile individuals who take unpopular stands. So Muhammad Ali has been a long-standing hero of mine. His name, before he changed his name, he was Cassius Marcellus.
Cassius, yeah.
So the Cassius, the Marcellus, the people know he was Cassius Clay. The Marcellus people forget. So the Marcellus comes from Muhammad Ali's Christian name, Cassius Marcellus Clay. Marcellus means little warrior, right? So we are a small firm. We're trying our best to make a big impact, but we are a small firm, and we said from the perspective of a startup, it's a good name, and it happens to be the name of my hero as well, and hence Marcellus.
Fantastic. You're also the author of 3 best-selling books, and you've explored the fund management side of the industry, and then you went on to write Unusual Billionaires, which culminated into your philosophy, which is the coffee can investing. Talk us through how this philosophy evolved. I mean, you have a very clear philosophy, and you guys have a clear way of investing, and which has worked over time. It's a very simple strategy. So
yes.
Just talk us through how it evolved.
So my next book with my friend Anupam Gupta, my next book will be published on 27 July. So I'll give you and your viewers here a sneak peek as to what's in that book. In effect, it's the evolution of our philosophy, and in that we've also discussed the evolution of the investment philosophies and the careers of other great investors like Ramdev Agarwal ji, Sanjay Bakshi ji, Mark Mobius, and so on. But actually, the origins of the philosophy lie when I was a 17-year-old working in a betting shop in London. So, 93, I finished my schooling, and for certain reasons, I couldn't go to college immediately. So I worked for a year, and I worked in a betting shop for a year, right? And I remember in those days in the betting shop, so right through the day, hundreds and hundreds of people would come and bet on football and dogs and horses and so on. But the people who'd come right at the first, when the shop opened at 9 a.m., some office goers would come, place their bets, and go to work, right? And then they would come the next day for their winnings. And what I noticed was the people who bet the least frequently,
right,
and were in the betting shop for the shortest amount of time, would make the most money, right? And that stayed with me, that the people, of these hundreds of people who would be my customers, and over time I could figure out how successful someone was, that the people who were spending the least amount of time in the betting shop, betting the least frequently, were making the most money. So I used to ask them, how do you do it? How come you come to the shop at 9 o'clock, even before the shop is properly opened, you place your bet and you go to work and you make money? And I remember one English guy telling me that, look, I mean, I've been doing this since I was a young boy and I enjoy it. It's fun for me. So I wake up at 6 o'clock. I have my coffee with the morning newspaper, and I read about either horses or cricket. And I've been doing this for 10, 20 years. So I know which cricketers to bet on, which horses to bet on. So he gave me one tip which has stayed with me forever. He says, this Englishman said, whenever the Indian team plays at Lords and Dilip Vengsarkar plays at Lords, he inevitably gets 100. So in my mind, the pattern is established that if India is playing at Lords, if Vengsarkar is batting, I bet on Vengsarkar to get 100, right? Now, as luck would have it, he got it. He played 4 times at Lords. Vengsarkar missed out only once. But that stayed with me, that if you are willing to follow patterns over long periods of time, then the world reveals itself to you in a way that others can't see, right?
Right.
And this English guy must have noticed that through the 80s, whenever Vengsarkar played at Lords, he got 100. So his mental model had built, and he would bet, right? So that was 93. And then in 2013, I was having dinner with a few friends, including one of my gurus, Sanjay Bhattacharya.
Right.
And he happened to mention over dinner in 2013 that, have you read this paper by a guy called Rob Kirby? It's called Coffee Can Investing. It's a 30-year-old philosophy. And basically Kirby says, buy a bunch of great stocks and sit on them forever. And as soon as he said that, I said, hang on, this sounds very similar to that English guy, what he had told me 20 years back. So I went home, I read Coffee Can Investing. It's a 4-page note from Rob Kirby.
Yeah.
And it made a lot of sense, right? And then it became a question of figuring out, how do we identify the signal? What is the signal to buy a great company, right? So I read around, and that was the reason I chose to write Gurus of Chaos, because I said, if I speak to 6, 7, 8 really high-class fund managers,
Right.
they will tell me what signals they use, and perhaps I can learn from that. So a little bit of trial and error, we hit upon return on capital and revenue growth as being the 2 most reliable indicators of a high-class company. 2015, I remember doing the first number crunching on it, and the results were startling. It showed that if you simply use double-digit revenue growth 10 years in a row and return on capital above cost of capital 10 years in a row, just that signal, and you don't do anything else, you beat the Indian market hollow year after year with very low volatility. And that led to Unusual Billionaires in 2016. And I think within 7 days of launch, it became a bestseller, which in turn led lots of people to ask us to launch a portfolio. And that's how the book became a portfolio. And here we are in 2020.
Right. I think even Fidelity did a similar study, and they figured out the most inactive demat accounts actually made the most amount of money over time.
Right.
Saurabh, I think whilst you've clearly articulated your philosophy in your book, The Coffee Can Investing, you've also gone one step deeper to find out why some of these companies deliver such high ROEs consistently, and why these guys are great capital allocators. So could you give us some insight on discussions, or let's say your insight into some of these companies as to why this happens? Because it's very rare, as you say.
Yeah, it's rare, Ashish, and ironically, it's getting rarer still. It's actually very interesting. So if you look at India today, we pointed out in a blog to clients a couple of weeks back that the top 20 profit generators in India, now account for 70% of the country's profits.
Right.
Back in 1990, the top 20 profit generators only accounted for 15% of the country's profits, right? I suspect by the time you and I retire, these top 20 companies will account for 80-85% of the country's profits, right? So what's happening is a few large companies are becoming incredibly dominant. Why are they becoming dominant? Right? From what we can see, Ashish, there are 2 different drivers at work here. One is regulation, right? What large companies are doing in India, sector after sector, is they're understanding very clearly what the regulatory paradigm is. And then they're obviously influencing regulation proactively. And over time, the regulators across the world, and this is a trend I'm seeing across the world, regulators are becoming very risk averse. What regulators are saying is that if a small, let's take, say, banking or asset management as an example, if a small bank or a small asset manager blows up, then their customers can create a stink in social media and make me look bad as a regulator. So let me not take any risks. Let me create such a stringent set of rules that no bank and no asset manager can blow up, right? Now, what that does is it helps the dominant players, the bigger banks and the bigger asset managers, become more and more powerful. And because the one size fits all, regulation suits the market leader but suffocates the smaller guys, right? And that's some trend I'm seeing across industries: FMCG, financial services, pharmaceuticals, right? The way FDA regulates a small Indian pharma company is identical to the way it regulates Pfizer, right?
Right.
How exactly is a small Indian or indeed a small Chinese or indeed a small American pharma company going to survive if Pfizer and the small company are regulated in the same way, right? So the regulation and the rise of modern society and modern social media, which makes regulators risk averse, is playing a role in stifling the smaller players and thus strengthening the hands of the market leaders. The second is technology. What technology, and especially technology which harnesses big data, is allowing market leaders to do is weaponize their data, right? So they're weaponizing CRM data and turning it into business analytics, which smaller players simply don't have. So to take an example, the way Asian Paints uses SAP, nobody else in India can, no other paint company, and indeed I suspect across industries, nobody else can use SAP like that. They have 50 years of proprietary data on paint demand at a very granular level, street by street, hour by hour, for 5,000 SKUs. Asian Paints has data. That data is fed into an SAP platform, ERP, basically an enterprise resource planning platform. It allows Asian Paints to generate a working capital cycle of 8 days. The number three player in that same industry, world-class company, has a working capital cycle of 105 days. How will you compete with 105 days working capital with the Asian Paints at 8 days working capital? The return on capital Asian Paints is 40%. The number three players return on capital is 15%. Right? Ditto with say NBFCs and say what Bajaj Finance has done with big data. Right? I don't think any other NBFC can match that, and therefore Bajaj Finance's weaponization of big data is actually their main moat that they built around the franchise. So yes, I can also go and buy Salesforce for Marcellus. In fact, Marcellus does use Salesforce. We simply don't have the data to feed into it in a way that a Bajaj Finance has, right? So it's not just a question of buying the SAP or the Salesforce, right? It's also a question of, do you have the big data to feed into it? The market leaders do, and that's allowing them to pull away.
Saurabh, I also wanted to explore a bit on, you also mentioned that these guys are extremely efficient capital allocators. But we've also seen instances where even great companies make capital allocation mistakes. So how do you catch that, or how do you view that? I mean, do you exit a company where you see consistent misallocation of capital?
Sure. So I think there's sort of three parts to this puzzle, right? The first part, as we were discussing a minute ago, is, has a company been able to create barriers to entry either through technology or regulation? Has a company been able to create barriers to entry which allow it to generate a return on capital much above the cost of capital? Because free cash flow is ROC minus cost of capital. So if your return on capital is consistently 25, 45%, you clearly have built a barrier to it. That's step one. Step two is, do you use that free cash flow to reinvest back in the business? There are plenty of companies in India who have good ROCs, but they don't reinvest heavily, right? So a Castrol, a Colgate Palmolive, a Unilever, they have tremendous ROCs, super franchises, great ROCs, but the reinvestment rate is not the 60 to 70% that we seek in Marcellus. So step two is, we need to see you putting money back in the business, because that's how you'll grow the franchise. And step three is, do you get your reinvestment calls right? Right? Now, there's two ways to gauge this, Ashish. If you reinvest capital inefficiently, over time, your ROC will trend down, right? Basically, on your incremental capital, you've screwed up and your ROC trends down. On the other hand, if you reinvest capital efficiently, your ROC will hold or indeed improve over time, right? Which is what we've seen with, say, Pidilite, right? Reinvestment of capital has been good, and last 10 years, Pidilite, Titan, ROCs have gone like that, right? So you can check it quantitatively, but also you can check it qualitatively. So one of the reasons that we read annual reports for the last 10, 15 years is we do exactly this, right? We see where has the promoter allocated capital over the last 10, 15 years, and how many calls has he got right, how many has he got wrong. We are all human beings. So if a promoter gets 2/3 right, 1/3 wrong, we're good with that. But if he gets 2/3 wrong and 1/3 right, obviously we need to be out of there. Right? And what you realize over time is, it's in a way, it's just like fund management. Just like a great fund manager like Warren Buffett gets majority of his calls right, not all of it, but he gets majority of his calls right. A great promoter, in effect, becomes a great capital allocator over time and gets the majority of his calls right, and that's all you need, right? So the promoter's main job, in fact, some would argue, William Thorndike, for example, has argued that the promoter's only job is capital allocation. The promoter should not be doing anything else. He should not be doing IR and product pricing and strategy. The promoter's only job is capital allocation, and that's what you measure the promoter on.
Right. So essentially, I think the longer you look, capital allocation is the holy grail for creating wealth. And in fact, it was highlighted very well by the book Outsiders.
Yes.
And you also have quoted that book multiple times by William.
Yes, a beautiful book. I think if you, one of the things we do is, I do it every year. I ask my colleagues to every year read The Outsiders once. It's just an outstanding book on capital allocation.
Right, right. So Saurabh, what happens actually in the market is when people invest, in the long run, everybody knows there are two contributors to creating wealth through a company or a stock. One is the underlying earnings growth, which is what is influenced by ROC and incremental allocation to capital. And the second part is the P multiple, right? Either the company gets a higher P rating if it does the first bit correct, or it gets derated. But the whole discussion, or 90% of the noise, is the second contributor, which is P. And so you had beautifully, I think in one of your blogs, you beautifully explained how in the longer run, P ceases to matter. And what really matters is the first part of the equation, which is earnings growth.
Yes. So let me see if I can find that, find some of the chart there. So you're right. So what happens in the human mind? The human mind focuses inordinately on the P multiple because it's the easy thing to focus on, right? Who the hell wants to kill themselves, read 10 years of annual reports and figure out a company's capital allocation? Let's do the lazy, let's use the lazy heuristic, which is focus on P, right? So the restatement of a stock price in a similar way, in a simple way, is P is equal to P times E. And as you just mentioned, Ashish, everybody organizes about P. The ability to focus on E is limited. And you can see how this plays out, right? You can see if you just differentiate the first equation, change in price, change in the stock price of a company becomes change in P plus change in E, right? And one of the simplest ways to understand investing is to break the Indian market into three layers. The first layer is airlines and telcos, companies whose earnings growth is close to zero. Why is it close to zero? Because they haven't been able to build barriers to entry. If you can't build barriers to entry, your return on capital will not exceed your cost of capital. You can't grow your business. And the only way a fund manager can then make money is by doubling the PE. Now, even if you double the PE in 10 years, right, you'd only make 7% compounded. And if the earnings engine dead, most of our airlines, our telcos, 90% of Indian stocks actually don't give you returns above a fixed deposit. 90% of Indian stocks don't give you returns above a fixed deposit, right? And then you come to the next layer of stocks, what I call Warren Buffett stocks, great companies with barriers to entry, say a Maruti being a case in point, or a Hero Moto or a Bajaj Auto, right? These companies do have some barriers to entry. They have a sales and service network. To take Maruti's example, they'll have 500 suppliers who will give them precisely machined parts. And therefore, a Maruti, out of 10 years, 6 years, Maruti will generate a return on capital of 25-26%, which is well above cost of capital. That gives it free cash flow. Maruti reinvests the free cash flow in new plants, models. Over a decadal cycle, Maruti's earnings growth will be a very respectable 12%. And then if you can time Maruti, buy it cheap, sell it expensive, you can generate another 7-8% of returns from market timing. And therefore, a skillful fund manager, the Indian equivalent of Warren Buffett, I would say, will generate a high teens return from a Maruti, right? The problem here is you do have to be very skillful to make money in Maruti, because if you mistime Maruti and buy it in a year like 2017, where it's sort of peaking out, you'll end up with disappointing returns. You'll end up with 12 minus 7, right? What is unique about India, and that's the reason we keep writing these books, what's unique about India, Ashish, unlike any other large market, our stock market has a third layer. The C is for CCP layer. Companies who are dominating essential products with very high ROCs, Nestle, Pidilite, Asian Paints, Dr. Lal PathLabs. With these sorts of firms, Ashish, the ROC is more like 45%, which means their free cash flow is 3 times that of a Maruti. Asian Paints or a Nestle free cash flow is almost 3 times that of a Maruti, which allows these firms to A, pay a good dividend, and B, even after paying a good dividend, reinvest 20% of capital employed back in the business every single year. If you keep reinvesting 20% of capital employed back in the business every year, in 4 years, the business doubles. In 8 years, it quadruples. In 10 years, the top line is up 6 to 7x, bottom line is up 8 to 10x. You get your to 25% earnings growth, which is 10x in 10 years, right? And if you can then get market timing right, you can end up with 32%, 25% from earnings, 7% from market timing, 32, add the dividend, you're potentially looking at 34, 35% returns, right? But the interesting part with the CCP stocks is, even if you get the market timing wrong, you mistime an Asian Paints or a Nestle or a Dr. Lal Path Labs, you end up with 18% returns, plus the dividend takes you to 20. So the interesting thing about India, and this is what makes the Indian market really, really interesting, is even if you mess up your market timing, if you invest in great franchises, the CCP franchises, you'll end up with higher returns than from investing in Maruti. The challenge, as you said, is to look beyond PE and realize that PE has no predictive power, right? The most counterintuitive aspect of investing is to realize that PE multiples have zero predictive power. They will not help you make money over a 1 month period, 3 month period, or 5 year, or a 1 or 3 year period. Right? PE multiples, zero predictive power is very hard for people to grasp.
I think the challenge, Saurabh, is that there are certain years like 2017 where the market goes crazy and the good, bad, ugly companies, all of them re-rate.
Sure.
Ugly ones re-rate the most. And
Right.
that's when it becomes a challenge to hold on or carry on.
Right. So in a way, it's the reverse of the COVID situation, right? So right now, you put it nicely. The way a lot of companies rallied that year was the reverse of COVID. Just like you don't expect, there's no reason for a lot of companies to rally 60, 70%. Just like COVID shouldn't have led to a 30% drop in the market. We shouldn't have had that rally. And in a way, our job becomes to understand these irrationalities, whether it's irrationality and the wild panic we saw in March, where I had people calling me up and sort of sobbing on the phone that their life was destroyed by COVID, right? And that told me that people were just losing their nerves needlessly. And the reverse in 2017, when I had my, the piece of, I go for a run in the morning, fellow joggers were offering me stock tips in 2017. The pendulum has swung the other way.
I think hence, to quote Buffett again, he says that investing is 90% temperament and 10% intelligence. So I hope you're able to write a book on the temperament part of investing as well.
We'll try our best. I think that our next book is on this process of learning how not just fund managers. We've also interviewed successful entrepreneurs like, say, Sanjeev Bikhchandani at InfoEdge, Manish Sabarwal at Team Lease. We've tried to explain how successful fund managers and successful entrepreneurs, how they learn, how they gather skills and mastery and knowledge over long periods of time, and how all of us therefore have a path to mastery, to hitting our peak potential. And we've tried to learn from that book ourselves, right? So first, let me figure out how to do it ourselves, and then we'll perhaps write the book on psychology.
Right. So the second strategy you chose to launch, Saurabh, was the little champ strategy, which was, which was at the other extreme. It was not even mid and small caps, but you chose to create a portfolio around micro caps. So walk us through, how that idea came about.
Right. So look, I think a big part of it is obviously the need for intellectual stimulus as well, and the need to do interesting stuff, find out about new companies that we can learn from, we can make money from. But here is where the idea came from. We noticed that what was happening in consistent compounders was that we were finding dominant franchises selling essential products, right? But on essential products that were large scale products. So baby milk powder is a 11,000, 12,000 crore market. And obviously Nestle, as the dominant player in baby milk powder, is a 1,50,000 crore market cap company, right? But then we told ourselves a couple of years back that, look, if Nestle can be a compounding machine in baby milk, and baby milk is a massive market, there are other niche markets. Which also have their dominant players, right? And we said, let's look for these. Let's look for dominant players in niche markets and see if we can identify them and see if they also compound in a similar way. So that's how the trigger started. What one of our colleagues, Pramod Gubbi, pointed out is that every year, 50 such companies make it into the BSE 500. So he said, look, if you look at these 50 stocks which are going in, what characteristics do they have? And Ashwin Shetty, our Little Champs fund manager, pointed out that these 50 entrants into the BSE 500 basically compounded 55% CAGR in their flight path into the BSE 500. And interestingly, the most resilient amongst these are dominant players in niche sectors, right? So that's what Little Champs does. It basically looks for the Nestle's of the world in niche sectors. To take an example, glass-lined vessels is an essential product. Without glass-lined vessels, you can't make pharmaceutical products. Pfaudler is the world leader. GMM Pfaudler is the India leader with 60% share, right? And if you speak to any large pharma company, right, or a large chemicals company, a United Phosphorus or a Dr. Reddy's or a Lupin or a Cipla or a Divi's Lab, they all swear by GMM Pfaudler, because their point is, if there's even a hairline crack in the vessel, my plant will be shut for 3-4 months. I need to use the best in the world. I need to use GMM Pfaudler, right? So that obviously gives GMM Pfaudler a barrier to entry, high ROCEs, 30-35%, free cash flows. They reinvest the free cash flow systematically. 2/3 of it goes back in, business compounds. And you can see why COVID actually is a great boon for these companies, right? What COVID has done is market share consolidation that would have taken 3 years to happen is happening in 3 months. So GMM Pfaudler's second largest competitor has basically announced that they're gonna shut shop, and effectively GMM Pfaudler, I reckon, in the next 6 months will become, rather than 70%, he'll become 80-90% of the sector. So you can see how dominant player barriers to entry crushes the competition. It happens quicker, actually. The crushing of competition happens more visibly in small cap, and COVID is obviously leading to an enormous boon for us, because this Little Champs portfolio, which we had started building in August, is now seeing enormous consolidation in its sector. So economic consolidation that could have taken 3 years is happening in 3 months, and perversely, it's actually going to be even more helpful for Little Champs to see the consolidation post-COVID than, say, consistent compounders. Nestle is already consolidated milk powder. He can't consolidate further. But GMM Pfaudler, or to take another name, alkylamines, can consolidate further. And our reckoning is over the next 6 to 12 months, we will see major market share gains by our Little Champs franchises, high cash flows, clean franchises, dominant franchises, reinvestment of surplus capital in a sensible way, and a compounding machines are thus built.
So essentially looking at smaller companies which can become consistent compounders over time, and probably they show early signs of that right now.
That's right. So in a way, the discovery is already done in Little Champs, and no prizes for guessing, where the entrance to consistent compounders might come from in the years.
Right. So you very lucidly explained some of the moats that these consistent compounders build around their businesses. You mentioned regulatory, you mentioned technological edge, and certain other moats that these companies create around them. Do you see any new industries, emerging industries with those kind of characteristics today in India?
I think in effect, I think our industry will be natural candidate for this, right? Because if you think about it, right, and I'm sure you know this better than I do, my reading is most high net worth individuals I still meet, the majority of their wealth is still is physical assets, real estate and gold and so on, right? But that's not a viable way to invest. Right? You're not going to make, your wealth is going to deplete. Your wealth is going to deplete if you're a majority invested in physical assets, whether it's real estate or gold. And therefore, over the next 10 years, our estimate is that we will see between 100 billion to $500 billion a year. Sorry, 100 billion to $500 billion a year. 100 billion to $500 billion a year come into the financial system from the liquidation of physical assets, right? So India's wealth, broadly speaking, as per the RBI studies I've read, India's overall wealth is around $10 trillion, of which well below $1 trillion is in financial assets. 9 trillion is in physical. So as that moves into our world, our industry will obviously grow leaps and bounds in the next 10 years, even if GDP growth doesn't.
And then of course we are adding incremental savings as well every year.
That's right. Now within our industry, we'll see the same Asian Paint effect, the GMM Pfaudler effect. You will see large companies who are smart at using technology, right? Who are smart at using technology and are able to deal with regulation well. They will build scale. Our industry doesn't need capex as such, right? So the free cash flow generation in our industry will be intense. And therefore, smart capital allocators, people I call kings of capital, smart capital allocators in our industry who are able to reinvest free cash flows intelligently will build massive scale over the next 10 years. So our industry will build over the next 10, 15 years, giant asset management, wealth management, insurance companies, and that is an area where we're doing a lot of work. Just because
Right.
this industry lends itself naturally to the Asian paints type phenomena, where you're using big data intelligently to build scale, barriers to entry, and monopolies.
Right, right, right. I think Saurabh, has been a fascinating conversation, and I didn't realize it's already 45 minutes into the conversation. I know we can go on, but before we conclude, I just wanted to know, other than reading and investing, any other hobbies or passions that you pursue?
Well, I think my wife's point is that whatever other passions you have, make sure the children's maths homework is dealt with, and make sure the kids learn maths. The reading, as you can imagine, the reading we don't have to worry about. So most of my spare time is creating maths puzzles for my kids. But that apart, before COVID, we used to travel a lot. We're missing our travel. So especially around India, we used to travel a lot. Uh, so once the lockdown eases, we'll be back to visiting the temple towns of South India and the Himalayas. This country is a gorgeous country to travel around, and hoping that we can get back to seeing the glory of the country shortly.
Right. At Motilal Oswal, we lay a lot of emphasis on knowledge. And before we wind this up, I definitely want to get, 3 book recommendations from you. I know
Right.
you are very well read, and there may be many books, in your.
So I think right in front of me, actually, I'm reading at the moment Ben Carlson, A Wealth of Common Sense. So I'd love to say read Coffee Can Investing, but that's my book. I don't want to plug my book shamelessly. But Ben Carlson, Wealth of Common Sense, I think is a brilliant book on personal finance. Probably the best book on personal finance I think written in the last 20 years. Wealth of Common Sense for skill building and understanding how skills build. Whilst Anupam Gupta and I were writing our book, we learned a lot from David Epstein's book Range. Right, super book on range and how skills develop by doing a whole variety of things through your career and learning from weird and wonderful places. And if I had to sort of think beyond finance, as to how politics affects countries and how countries change, right? It's, I think, for people like us who are still, we are still a very young democracy, right? And we will go through in the next 10, 20 years enormous political and economic change. How does political and economic change affect our lives, our wealth, our incomes? A super book on that is Robert Gordon, The Rise and Fall of American Growth. In fact, if you wanted to understand what will happen in India in the next 20 years, I think the first 150 pages of Robert Gordon, The Rise of Fall of American Growth, will probably give you the best insight that I think anybody can give. Just epic book. It's a big book, but first 150 pages I think should be essential reading for anybody who cares about their wealth and their fortunes in this country.
Right. So thanks a lot, Saurabh. It's been a very interesting and insightful conversation. And I'm sure a lot of our viewers found this insightful as well. So if you like this conversation and you like this episode of Know Your 4C Manager, please subscribe to our YouTube channel. Else, you can go to our website as well and find this material. So thank you very much for watching. And this will be put up on our YouTube channel, so you can watch it later as well. Thanks a lot, Saurabh.
My pleasure. Thank you.
Thanks.